Picture this for a moment. You're checking your mail just like any other day when you see a certified letter from the US government. You open it expecting nothing more than routine paperwork, but instead it says you failed to report a foreign bank account. The penalty listed is $30,000. Your US bank accounts are frozen. And if you're a green card holder or applying for citizenship, your immigration case is suddenly at risk. All of this because of a small account overseas you barely use. Maybe one you opened decades ago, maybe one with just a few $1,000s in it. Now, let me be very clear right from the start. This is not a scary story meant to panic you. This is exactly the kind of situation that is going to become shockingly common under a brand new banking rule taking effect in 2026. And if you are over 60 years old, a green card holder, or someone who was not born a US citizen, this change could affect you far more than you realize. Most people assume that if an account is small, inactive, or back home, it doesn't matter. They assume that because they've filed their taxes honestly for years, they're safe. But the rules are changing in a way that removes those assumptions completely. What used to slip by unnoticed will now be flagged automatically. What used to be forgiven as confusion can now trigger penalties, investigations, and immigration complications. The good news is this. If you understand what's coming and you prepare the right way, you can protect yourself entirely. You can avoid penalties, you can avoid audits, and you can avoid problems with your immigration status. By the end of this video, you'll know exactly what this new rule is, why it targets seniors and immigrants, and what simple steps you can take right now to stay safe. So take a breath. You're not in trouble. You're here early, and that puts you in the strongest possible position. For years, I've helped seniors, immigrants, and green card holders make sense of complicated U.S. financial and immigration rules that often feel overwhelming and unfair. I work with people who are retired on fixed incomes, people supporting family members overseas, and people trying to build a secure life in the United States while doing everything the right way. I know how stressful this can feel when you're managing retirement, medical expenses, or immigration paperwork. The last thing you expect is for a forgotten bank account in another country to suddenly become a major legal issue. Most people I speak to are not trying to hide anything. They simply didn't know the rules existed, or they assumed the rules didn't apply to them. That's exactly why this new 2026 banking rule is so dangerous. Not because it targets criminals, but because it catches honest, hardworking people who never realized they were at risk. And unfortunately, the government is not doing a good job explaining these changes in plain, simple language. Important details are buried in technical documents that most people will never see until it's too late. My goal here is different. I'm not going to use legal jargon. I'm not going to talk down to you, and I'm not here to scare you. I'm here to explain what's changing, why it matters, and how you can protect yourself step by step. Nothing more, nothing less. Over the next several minutes, I'm going to walk you through exactly what this new banking reporting rule is, who it affects, why seniors and immigrants are being singled out, and what actions you should start taking today, not in 2027 when the first penalties start showing up. If these rules apply to you, you'll know it. And if they don't, you'll have peace of mind knowing exactly where you stand, because knowledge is protection. And right now, knowing what's coming could save you from a financial and emotional nightmare that is completely avoidable. So let's talk about what is actually changing, because this is where everything begins. Starting with the 2026 calendar year, which means the tax returns and reports you'll file in early 2027, the U.S. government is rolling out what it calls an enhanced foreign account mandatory reporting system. That sounds technical, but the impact is very real and very personal for millions of people. This is not a minor update to an old form. It's a major expansion of how foreign financial accounts are tracked, reported, and enforced. And for the first time, the rules are being applied differently depending on your age and where you were born. Here's the first change you absolutely need to understand. The reporting threshold for foreign bank accounts is being dramatically lowered for specific groups of people. Under the old system, you generally only had to worry about reporting foreign accounts if the combined value of all of them went over $10,000 at any point during the year. For many people, that meant these rules never came up at all. That $10,000 threshold is staying in place for younger people who were born in the United States. But if you are over the age of 60, or if you were not born a U.S. citizen, that threshold drops sharply. In most cases, it drops to just $5,000. And for some people, depending on immigration status or where they are in the citizenship process, it can drop even lower, sometimes to around $3,000. Think about what that really means. An account with a few $1,000s that you've never thought twice about can now trigger mandatory reporting. A small savings account you keep in your home country for emergencies or family visits can suddenly fall under strict scrutiny. Even if you only cross that lower threshold for a single day during the year, the reporting requirement is triggered. And here's the part that surprises most people. This isn't about how much income the account generates. It's not about whether you withdrew money. It's about the highest balance the account reached at any point during the year. So if you briefly deposited money, sold a small asset, or received a one-time payment that pushed the balance over the limit, that alone can create a reporting obligation. Now, that's only the first change. The second change is just as important, and it's where many people get caught without even realizing it. The definition of what counts as a foreign financial account is being expanded significantly. Under the old rules, most people thought only of basic checking or savings accounts. But under the new system, the net is much wider. Foreign retirement accounts now count. That includes pensions, employer retirement plans, and government retirement benefits held outside the United States. Life insurance policies issued by foreign companies that have any cash value now count. Prepaid debit cards issued by foreign banks count. Digital wallets held with foreign financial institutions count. Even partial ownership interests in foreign property or businesses can count if those interests generate any kind of financial return or income. In simple terms, if you have any financial connection outside the United States and it has any value at all, there is a strong chance it now falls under these reporting rules. This is especially true for immigrants and seniors who maintained financial ties long before these rules existed or before they ever imagined they would matter in the U.S. Many people hear this and think, but that's not really an account. That's just something I've always had. Unfortunately, the new system doesn't care how you think about it. It only cares whether the asset exists, where it's located, and whether its value crosses the new, much lower threshold. And this is where things start to feel overwhelming, because when you begin to add up a small pension here, a modest savings account there, and a life insurance policy you haven't looked at in years, you can cross the threshold without ever realizing it. But before you start feeling anxious, there's something even more important you need to understand. Because these changes aren't just about what you're required to report, they're about how the government now finds out when something is missing. And that next change is the one that removes almost all room for error. Here's where this new system truly changes everything. For decades, one of the reasons people slipped through the cracks was simple. Government agencies didn't talk to each other very well. Information lived in separate systems. A small account overseas might be reported in one place, partially mentioned in another, or not connected at all. That era is ending completely. Starting in 2026, the IRS, FinCEN, and U.S. Citizenship and Immigration Services are implementing full real-time data sharing. In plain English, that means every piece of foreign financial information you report is automatically cross-checked across multiple federal agencies. If something appears in one system but not another, the computer flags it instantly. There is no human judgment call first. There is no, "this seems minor." The system simply generates a notice. So if a foreign bank reports an account linked to you, but that account doesn't appear on your tax return or foreign account reports, it's detected. If you answer no to a foreign account question on your tax return, but FinCEN has data showing otherwise, that inconsistency is flagged immediately. If USCIS is reviewing your immigration file and sees unresolved financial compliance issues, they see that automatically, without requesting anything from you first. This is what makes the new rules so unforgiving. It's not that penalties are new, it's that mistakes are now far more likely to be discovered automatically. There is almost no room left for something to be overlooked simply because it seemed too small or too old to matter. And as part of this same shift, the government is eliminating most of the exemptions people relied on in the past. Under the old rules, some accounts didn't need to be reported if they were inactive. Some jointly held family accounts fell into gray areas. Some people assumed that accounts opened decades ago or accounts used only once a year didn't really count. Those assumptions no longer apply. If you meet the age or citizenship criteria, and you have a foreign financial connection above the new lower threshold, you must report it. It does not matter how often you use it. It does not matter who else is on the account. It does not matter how long ago it was opened. If it exists, it must be disclosed. Period. Now, at this point, almost everyone asks the same question. Why seniors? Why immigrants? Why create stricter rules for certain groups of people? And it's a fair question. According to government studies conducted over the past several years, seniors over 60 and immigrants are statistically the most likely groups to have unreported foreign financial accounts. Not because they're doing anything wrong, but because their lives are more likely to span multiple countries. Seniors often worked overseas, retired abroad for periods of time, or maintained accounts in other countries long before these reporting rules existed. Many simply never realized U.S. law requires reporting worldwide financial assets, no matter how small or how old. Immigrants face the same issue for different reasons. Millions of people who move to the United States keep financial ties to their home countries. They support parents. They hold on to small retirement savings. They own partial interests in family homes or businesses. From their perspective, those accounts are separate from their American life. But under U.S. law, they are absolutely not separate. The government's response to this widespread, unintentional non-compliance is not education. It's enforcement through visibility. By lowering thresholds specifically for these groups and embedding mandatory questions directly into standard tax forms, the government is removing the ability to say, I didn't know. And by linking IRS, FinCEN, and USCIS data, they are making sure those answers are verified automatically. That's why understanding this now matters so much. Because once these systems are fully active, confusion is no longer treated gently. Preparation is the only real protection. Before we go any further, I want to pause for just a moment. If what you're hearing right now is new to you, or if it's making you realize you might need to take a closer look at your own situation, please take 1 second to like this video. Not for the algorithm, but because the more people who see this, the more seniors and immigrants can learn about these changes before they accidentally put themselves in serious trouble. A simple like helps this information reach the people who need it most. Thank you. Now let's talk about how these new rules affect different groups of people because the impact is not the same for everyone. And this is where a lot of dangerous assumptions come into play. If you are over the age of 60 and you were born in the United States, you might be thinking, this doesn't really apply to me. I'm not an immigrant. I've been a citizen my whole life. That assumption could get you into real trouble. Under the new system, age alone is enough to trigger enhanced reporting requirements. Any person over 60 who has any foreign financial connection will now face much more detailed questions on their annual tax return. If you receive a small pension from another country, if you worked overseas at any point in your life, if you maintain a bank account abroad for travel or family reasons, or if you have any ownership interest in foreign property or investments, you are now firmly on the reporting radar. What's changed is not just whether you have to answer these questions, but how detailed those answers must be. The IRS is no longer treating foreign assets as something only wealthy people need to worry about. Under the new rules, even a dormant account with just a few $1,000s in it can trigger reporting requirements if you are over 60. An account you only use once a year still counts. A joint account you share with siblings or aging parents still counts if you have access to it. The underlying assumption of the new system is simple and strict. If any foreign financial connection exists, it must be reported completely and accurately. The system is designed to assume nothing and verify everything. That means guessing, skipping questions, or thinking, this probably doesn't matter, is no longer safe. For many seniors, this is especially unsettling because these accounts often feel like part of a past life, something you set up decades ago and barely think about anymore. But the system doesn't care how emotionally distant the account feels. It only cares that it exists and that it meets the reporting criteria. If you are a green card holder, the stakes under these new rules are significantly higher. This is where financial compliance and immigration status become tightly connected. As a lawful permanent resident, you are already required to follow the same tax and financial reporting rules as U.S. citizens. That has always been true. What's new is how closely those records are now being examined by immigration authorities. When a green card holder applies for U.S. citizenship, USCIS conducts a detailed review of their tax history as part of the good moral character requirement. Under the new real-time data sharing system, USCIS doesn't have to ask you for this information. They see it automatically. They can see whether you answered foreign account questions correctly on your tax returns. They can see whether required foreign account reports were filed. And they can see whether the information matches across different forms and agencies. Here's the part many people don't realize. Even if a failure to report was completely unintentional, it can still create serious problems. It doesn't automatically mean your citizenship application will be denied, but it can trigger delays, additional interviews, requests for documents, and referrals for further review. In more serious cases, repeated or significant reporting failures can be used as evidence that you do not meet the good moral character standard. That is a consequence most people never see coming, and it's one of the reasons so many naturalized citizens are caught off guard by these changes. To really understand why all of this matters, let me share a real situation. Maria was 72 years old. She immigrated to the United States from the Philippines nearly 30 years ago, became a permanent resident, worked hard her entire life, and retired on a very modest Social Security income. Back in the Philippines, she kept a small savings account with about $8,000 in it. She used it once a year when she visited family and to help pay for medical care for her elderly mother. From Maria's point of view, that account had nothing to do with her life in America. It was small, it was far away, and it barely changed from year to year. Maria always filed her U.S. tax returns honestly. She reported her Social Security income, claimed the standard deduction, and never owed taxes. Because her income was low, she assumed everything was fine. What Maria didn't know was that she was supposed to report that foreign bank account. No one ever explained FBR rules to her. The instructions were buried in technical publications she never saw. For more than 15 years, nothing happened. Until it did. Her story is exactly the kind of situation the new automated system is designed to catch. And her situation is far more common than most people realize. If you're realizing right now that you should have been filing FBARs in the past but didn't, do not panic, but also do not ignore it. The IRS and FinCEN offer streamlined filing procedures that allow people to correct past mistakes with reduced penalties if the failure was not intentional. The absolute worst thing you can do is recognize a problem and hope it goes away on its own. Under the new data sharing system, unreported accounts are far more likely to be discovered. Taking action voluntarily before the government contacts you puts you in a much stronger position and can save you from massive penalties later. If you start preparing now instead of waiting until the first 2027 deadlines under the new rules, you can avoid penalties, avoid audits, and avoid immigration complications entirely. Make a full inventory of every foreign financial connection you have. Bank accounts, retirement accounts, pensions, life insurance policies with cash value, digital wallets, and any ownership interests in foreign property or businesses. Review your past FBR filings to confirm they were completed correctly. Gather your documentation early. And when converting foreign currency amounts to US dollars, make sure you're using the correct exchange rate for the correct date, because this is one of the most common places people make avoidable mistakes. Preparation gives you peace of mind. Waiting creates risk. And there is no better time than right now to get ahead of this. Let's bring everything together. Starting with the 2026 calendar year, the U.S. government is implementing a new enhanced foreign account reporting system. If you are over 60, or if you were not born a U.S. citizen, the reporting threshold for foreign financial accounts drops from $10,000 to $5,000, and in some situations, even lower. The definition of what counts as a foreign financial account is expanding. It's no longer just checking and savings accounts. Foreign pensions, retirement plans, life insurance with cash value, digital wallets, prepaid cards, and certain ownership interests in foreign property or businesses can now count. At the same time, the IRS, FinCEN, and USCIS are sharing information in real time, which means unreported accounts and inconsistencies are far more likely to be detected automatically. The penalties for getting this wrong can be severe. Large fines, extended audits, and serious immigration consequences for green card holders and future citizens. But none of this means you're powerless. If you take action now, you can protect yourself completely. If you found this video helpful and you want to stay informed about future changes that affect seniors, immigrants, and anyone navigating U.S. financial and immigration rules, please subscribe and turn on notifications. Regulations change often, and staying informed is one of the best ways to protect yourself and your family. And I need to leave you with an important reminder. Everything shared in this video is for general educational purposes only. It is not legal advice, tax advice, or immigration advice. Every person's situation is unique, and the rules that apply to you can depend on many individual factors. If you have questions about your own situation, you should consult a qualified tax professional, enrolled agent, CPA, or immigration attorney who can review your specific circumstances and give you personalized guidance. Always rely on official guidance from the IRS, FinCEN, and USCIS when making important decisions. Thank you so much for taking the time to watch and educate yourself. Stay informed, stay prepared, and stay protected.